Hi everyone and welcome to another episode of the Patient Wallet channel. I have a few things to get through in this episode. We'll talk about what happened last week, have a look at my portfolio and share a few stocks that I'm currently looking into, given we're at the beginning of a new interest rate cutting cycle. Last week, probably you felt the mood swings of the market. The start of the week, the market was spooked. I think there were two main reasons for this. Firstly, an MIT report suggested that 95% of AI pilots fail, which spooked investors. Secondly, Sam Altman, OpenAI CEO, reportedly said that he believes AI could be in a bubble, comparing the market conditions to those of the dot-com boom in 1990s. And we all know what happened during that period. As a result of the report and comments, you had the markets going down by 1.5% at the beginning of the week. However, on Friday, Jerome Powell saved the markets as he came across as more dovish. The key highlights from the speech are as follows. The tone was a shift in policy in their dual mandate. Their mandate is to avoid high inflation and high unemployment. He highlighted that there are both risks that inflation can remain high and unemployment can rise as well. The shift to the policy stance were comments made, and I quote, "Nonetheless, with policy in restrictive territory, the baseline outlook and the shifting balance of risks may warrant adjusting our policy stance." End quote. In other words, unemployment will play a bigger factor in determining if there is going to be a rate cut or not. On the other hand, he also mentioned that tariffs are a risk to rising inflation and are starting to be seen in consumer prices. As a result of this speech, the markets are now expecting a 25 basis points cut in September, and the chances of that happening at the moment is 77%. So given the more dovish message from the Fed, the markets rallied on Friday, offsetting some of the losses from earlier in the week. As you can see from the chart here, the companies that were hit the most during last week were tech companies, semiconductors, and any other company that is involved in AI. You have Nvidia falling by 1.3%, Broadcom by 4%, Palantir by 10%, Oracle by 5%, AMD by 5.5%, and so on. I'll now move on to my portfolio. We have 5.9k invested, and it's been almost a month that we have been investing. And as you can see, I'm invested in 3 stocks. My greatest conviction is Google, and this is reflected by the fact that my invested portfolio is 53.7% allocated to Google, followed by Amazon at 28%, and then Adobe by 18%, which is my most recent purchase, which was last week. Performance-wise, Google is up 8.8% since I bought into the company, Amazon up 6.2%, and Adobe 2.5%. I think given the recent uncertainty we've seen in the markets, it's worthwhile going through my investment thesis on all 3 of these companies. Before I jump into my individual stocks, let's look at high-level stats of the overall portfolio. Revenue growth of the last 3 and 5 years was 10.5 and 16.3% respectively. Diluted EPS 3-year and 5-year CAGR was 36.3 and 31.2%. Gross profit margin, operating margins, and net profit margins are 61.7%, 27.6%, and net profit margin is 25.1%. These companies also have high return on investment capital and return on equity. The return on investment capital is 24.9% and return on equity is 35.1%. From a valuation perspective, we have a trailing PE of 25.8, the forward PE 23.5, and free cash flow yield is 2.7%, and forward free cash flow yield is 3%. So let's jump into the companies and going over my investment thesis summary. So starting with Google, which is my biggest conviction at this point in time, the company owns a combination of businesses that are world-class in my opinion. It remains the dominant player in search. YouTube is the streaming leader and has years of growth ahead. Google Cloud is the 3rd largest cloud provider and growing fast. They are the most comprehensive and vertically integrated AI provider, as they have the talent, leading models, physical infrastructure, and consumer interface. And lastly, these days offer impressive hardware on top of software, expanding their ecosystem and subscription businesses, and they also have the optionality and long-term bets such as Waymo. Why am I becoming more bullish on Google every single day? We had recent wins. Meta is expected to spend $10 billion in the next 6 years with a Google Cloud deal. Apple is looking into Gemini to power their Siri. Lastly, a judge found that Google has formed an illegal monopoly in its advertising business earlier this year, and it's aimed to issue remedies by the end of August. So once this event happens, uncertainty levels for Google will drop. I'm not sure it's fair for a judge to ask Google to split up their business, but regardless, some of this uncertainty falls away. Lastly, some interesting facts came out from Google regarding the environmental impact of delivering AI. This report suggests that Google can serve more prompts per energy usage, which I think is very important when it comes to the inference game that AI is entering into. I think the market narrative that AI is killing Google's search business, it's wrong. As we can see from this chart, the segment is still growing at 11.6% based on last 12 months. But also we've seen Google executing strongly in the last 6 months, and I expect them to continue to do so as they become more competitive with their products. Moving to company number 2, which is Amazon. When I close my eyes and think what will happen to them in 20 years time, I expect the company to be larger, still have the relentless focus on customer service, and probably expand in new markets that we have no idea about. Historically speaking, Amazon has showed tremendous ability to increase their total addressable markets. They started with selling books and will end up offering internet from space. Just think about that for a moment. I believe this doesn't change as they have this unique culture. Over time, Amazon becomes more predictable as their service-based revenues are growing faster. Amazon will benefit as the leader in cloud. Prime, in my opinion, is hands down the most value for money subscription out there. Project Kyber, their low Earth internet service launching soon, will also be a meaningful part of their business in the coming years, and they are also part of the robot taxi industry with Zoox. Another thing that I like about Amazon is the fact that this is one of those companies that truly leans in when they see a growth opportunity. We can see this from this CapEx chart here. As you can see, Amazon is the only company that was willing to ramp up CapEx over the recent years. They've done this around 2020 and 2021, where they doubled their fulfillment centers. And they're also doing this now as they are investing heavily in AI and cloud infrastructure that they see growth. To put things into perspective, you'll see that Amazon's CapEx is $108 billion, which is almost the same amount of CapEx invested by Meta and Microsoft. Amazon will have a problem soon, a nice problem to have in my opinion. I think they will be forced to start returning some cash to shareholders. The $108 billion CapEx spend cannot go on forever, and not because Amazon cannot live with it, but because there aren't many industries that can take this much CapEx for many years. And even though we see this free cash flow excluding stock-based compensation yield being a negative 0.3%, if we assume that CapEx was normalized around $50 billion a year, Amazon would be trading closer to 2% of free cash flow yield. Final one for Amazon, I do think they are the number one company to benefit from robotics and automation. They have this massive top line that even small margin improvements will lead to outsized returns, and I think the market is not pricing this properly at the current levels. And moving to my last company, this is Adobe, and my most recent buy was last week, which I also made a video, so if you haven't watched that, go and check that out. My investment thesis on Adobe is very simple. It trades at ridiculously low valuations, has one of the most high quality revenues out there, and once again, market believes that AI will kill their business, whereas I think the exact opposite, AI should enhance Adobe's business over time. Their trailing 12-month PE is 23.2 and their forward PE is 16.7. And when comparing that with their median forward PE of 31.1, the company currently trades at about half of that multiple. Similarly, and as you know, I like to look at the free cash flow yields. The free cash flow yield for the company is 5.93% and the free cash flow yield excluding stock-based compensation is 4.76%. The higher the number is, the cheaper the company is trading at. And again, when comparing it with the median of 2.2%, we can say that the company is trading at much lower valuation levels when compared to historic ones. We can also see that Adobe has growing revenues, with 96% of these revenues being extremely high quality as their subscription-based revenues. This is in green bar here. Market believes AI will kill their business. I think AI will enhance their business. They offer everything, plus layering AI models and features on top will enhance the value proposition of Adobe's. And my opinion is that their AI strategy is the right one, as they are offering users the ability to use AI in a safe manner, as their models have been trained on licensed data, which I think is very important for a creator. You want to avoid a situation like Midjourney, where you have been sued for generating images very similar to Disney's characters, for example. Okay, this is my current investment portfolio, and as I mentioned earlier, given the new rate cutting cycle, I'm looking into a few additional companies to invest in, which are these ones here. We have FICO, Equifax, S&P Global, Moody's Corporation, D.R. Horton, Pulten Group, and Toll Brothers. I'm not going to go through a lot of details on these companies as I am early days in my research. Once I figure out which one is the best to invest for myself, I'll let you know on this channel here, so make sure you subscribe to not miss that out. Fair Corporation, also known as FICO, develops analytics, software and data management products and services that enable businesses to automate, enhance and connect decisions around the world. It operates through two segments, scores and software. The company currently trades at a P of 53.5 and has a market cap of $33.9 billion US, and it has a net debt position of around 2.6. If you've been following the markets or FICO, you would know that year to date FICO has been decimated. It's down 28.9%. And looking at one of my favorite valuation metrics, which is the free cash flow excluding stock-based compensation yield, FICO trades at 1.74% at this point in time. Going to the next one, Equifax provides information solutions and human resources business process automation, outsourcing services for businesses, governments, and consumers. The company operates through three segments: Workforce Solutions, US Information Solutions, and International. The company trades at a P of 47.9, has a market cap of 31.6 billion and a net debt position of 4.7 billion. Year-to-date return is 3%, and the current free cash flow excluding stock-based compensation yield is 2.7%. I see FICO and Equifax, two companies that will benefit from lower rates as mortgage inquiries will rise, and both of these companies are expected to benefit. The key difference here is that Equifax is slightly more diversified than FICO, but I think both of these companies will benefit from lower rates. Next one is S&P Global. It provides credit ratings, benchmark analytics, and workflow solutions in the global capital, commodity, and automotive markets. Year to date, the return is 12.2%, pretty good for SPGI. It's a much larger company than Equifax and FICO, with a market cap of $170 billion US and a PE of 42.5. The company also has a net debt balance of $10.2 billion US. The free cash flow yield, excluding stock-based compensation for S&P Global, is 3%. Moving on to the next one, Moody's Corporation operates as an integrated risk assessment firm worldwide. It operates in two segments, Moody's Investors Service and Moody's Analytics. The Moody's Investor Service segment publishes credit ratings and provides assessment services on various debt obligations, programs, and facilities, and entities that issue such obligations. The year-to-date return is 9.2%. The market cap is 92.6 billion, the PE is 43.4, and the company has a net debt balance of 5.10 billion US dollars. The free cash flow excluding stock-based compensation for Moody's is at 2.3%. I see S&P Global and Moody's benefiting from interest rates coming down, as their credit rating businesses should significantly grow as businesses refinance their debts. The last three companies are home builders. D.R. Horton operates as a home building company in the US. It engages in the acquisition and development of land and construction and sale of residential homes in 31 states and 98 markets. The company constructs and sells single-family detached homes and attached homes such as townhomes, duplexes, and triplexes. The market cap is 50.9 billion, the PE is 13, and the year-to-date return is 24.7%, and as you can see, this rise has only been since July 2025. The company has a net debt balance of 5 billion, and the free cash flow excluding stock-based compensation yield is 4.9%. Moving on to the next home builder, Pulte Group, I hope I'm not butchering their name, primarily engages in the home building business in the United States. It acquires and develops land primarily for residential purposes and constructs housing on such land. The market cap is 26.1 billion, the P is at 9.4, and the year-to-date return is 23.6%. The company has a net debt balance of 1 billion, and the free cash flow yield excluding stock-based compensation is at 4.7%. And moving on our last home builder, Toll Brothers, the company designs, builds, markets, sells, and arranges finance for a range of detached and attached homes in luxury residential communities in the United States. The market cap is 12.7 billion, the P is 9.7, and the year-to-date return is 12.1%. The company has a net debt balance of 2 billion, and the free cash flow excluding stock-based compensation yield is trading at 5.7%. So these are the three home builders that I'm currently looking into. And as interest rates come down, I expect the house market activity to pick up, and as a result, these home builders to also benefit. I also think that these home builders are interesting because they are trading at low valuations, as we've seen from low P's and high free cash flow yields. To summarize, the first two companies, FICO and Equifax, should benefit from increased mortgage inquiries. S&P Global and Moody's are expected to benefit from businesses refinancing their debt. And D.R. Horton, Poulton Group, and Toll Brothers, the home builders, I expect them to benefit from rates coming down as house market activity goes up. That's it for this episode. Let me know which of these 7 companies you expect to do best in this new rate cutting cycle, and I'll see you in the next one.